All right, welcome to today's webinar topic. We are going to look at momentum trading strategies for the Forex market. So the topic here, or the agenda, I should say, is how do we identify momentum in the Forex market? And then we'll take a look at a simple momentum trading strategy. We'll take a look at couple of different ways of trading this strategy. One is over the long term and then over a shorter period of time for intraday trading. And then also looking at how do we properly implement this strategy. So we'll talk about where to put when to enter the trade, when to exit the trade, where do we put our stop loss, and that sort of stuff. Oh, going. Okay, so just for those who don't know me, just a little bit of detail here about me. I am a full-time Forex trader. I've been trading for about last 7-8 years. I have 2 MBA degrees from Cornell University in the US and Queen's University here in Canada. My background was in IT before I got into the financial markets. So getting into the topic here today, first thing we need to understand when we start trading is what is the market direction. And if we can get the market direction correct, our trading can be a lot more profitable than we may be at our current level. So in terms of market directions, there's only 3 ways the market can go. It can either go up, or it can go down, or it can go sideways. So let's take a look at what that means. When we talk about market direction being to the upside, we talk about an uptrend. Basically, what the market is doing is making higher highs and higher lows. So what that means is the next high that comes into the market shouldn't be down here. So market doesn't just go in one straight line. It will go up, it will pull back, then will go further up again, and then pull back and up again. So it has this ladder or a stair step type of formation where it goes up and down. However, if the market, that's next high that the market makes is down here, so for example, market comes down, let me just draw this. So let's say the market goes up, then comes down, and then the high is over here. This is not, this type of market is not a trending market. So for an uptrend to be in place, the market would have to make higher highs and higher lows. So similarly, for a downtrend, when the market, we consider market being in a downtrend, market is essentially making lower high and a lower low. So each step would be lower. So again, lower low, lower high. So again, like I said, the market doesn't just go in one smooth move to the downside or upside. It will go down, have a pullback, go down, have a pullback, and that sort of stuff. So if the second high is above this previous high, that is not a downtrend. So in that case, the market is not in a downtrend. So the third thing that can happen in terms of market movement can be a sideways trend, which is also called a range-bound market. So basically, the price is not really going anywhere. It doesn't have a nice stair-step kind of movement to it. It goes up, comes down, goes up, then goes further down, and does this type of a movement where it just goes up and down like this. It's kind of like think about it like a river flowing. It's just up and down, no clear direction in the market. So this is called a range-bound market, and usually in a range-bound market we have a lower support area and upper resistance area, and market tends to just bounce back between the two. So for momentum trading, we do not engage in the range-bound market. If the price is not going anywhere, we don't do anything with it. So the only 2 market conditions that we are interested in is uptrend or downtrend. So let's take a look at we are going backwards here. Okay. So how do we identify, first of all, how do we identify the direction in the market? And then how do we trade that direction? So momentum trading is really a subset of trend trading. So we identify the trend, first of all, and then we look for price to move with momentum. So what does momentum mean? Momentum simply means a quick price move. So when the price is going sideways, there's no quick move. It could go up and down, and we've been seeing that lately in the New York markets with the majors. It just goes sideways. To identify the momentum in the price or the trend in the market, we use a simple indicator which are called the moving averages. So for the moving averages, there are 4 different moving averages that we will use on our chart, and I like to put them on a 1-hour chart. However, if you're trading shorter term time period, you can also put them on a 15 or a 30-minute time frame charts as well. So the simple moving averages, that we are going to look at will be, first is 8 simple moving average, then 20 simple moving average, 50 simple moving average, and 200 simple moving average. So these are the 4 moving averages that we will have on our chart. When the moving averages are fanning, that means when they are separating, we have a trend, or we have momentum in price. That means the price is moving away quickly, and that's the price behavior we want to see. And we'll use moving averages to see that sort of price behavior. So we're looking for moving averages to be fanning. So let's take a look at an example of this case. So here is an example we're looking for. This week, the yen pairs, Japanese yen pairs, were trending very, very nicely, had a lot of momentum in those trades, and I took some of those trades. So these are some of the charts that I wanted to pull just because there was some nice move in the yen. So here, see here, this is where the moving averages are coming together. So this type of market conditions are not what we are looking for. We're looking for moving averages to actually be getting apart. So this is where they are separating, where the moving averages are actually pulling away from each other. They are fanning. So this is what we're looking for, this type of a price movement where they're moving away from each other, not when they are squished together. Like you will see, for example, in Euro US dollar last week, they were just squished together, and there's really there's no momentum in that type of a market. They are just consolidating, and we want to stay away from that type of market when we are trading momentum in the market, because you're not really getting anything in that type of a market. So we install, or we load our indicator. Moving averages comes with any kind of charting platform that you have. MT4 is an easy one that everybody has access to. So these will be within the MT4 in your platform, or if you're using TradeStation or NinjaTrader, all the trading platforms will come with a moving average indicator. So you just basically go in and add that indicator. So how do we, what are we looking for once we have installed our indicator? So for the moving averages, we are looking for them to be stacked. And what I mean by that is that we look for the smallest moving average to be on, so let's say we are going up. We are looking for an uptrend. So we will have the 8 moving average first, and then we'll have the 20 below that, and then we'll have 50, and then 200. So they need to be on top of each other. So basically, so we'll have 8 here, and then we'll have our 20 below, and then the 50, and then the 200. So if these are not stacked like this, they're not in the ascending order, then we have a problem, and we should not be getting engaged in the market. So for the downtrend, it will be the opposite. So 8 will be at the bottom, and then we have the 20 moving average, 50 moving average, and then 200 moving average. So they need to be stacked on top of each other. For the bullish move to the upside, we need 8, 20, 50, and 200. And when the price is moving down, we need the opposite. So 8, 20, 50, and 200. So once you have the moving averages, next thing you want to do is identify your support and resistance area. So make sure you put this support and resistance area on two different time frames. So for example, if you're trading the 1 hour chart, make sure you draw your support and resistance on the 1 hour chart and also on the 4 hour chart. So you have both support and resistance areas drawn. This way it gives us the extra confluence, so we know if there's a support on 1 hour as well as the 4 hour, you know that that is an important support and resistance area, and you can actually take a trade off of that. So to enter the trade, what we're looking for is, one, the price to start moving, and I'll show this on the charts a little bit, but I'll just explain this. So we want the setup to be at important support and resistance area. So we're not going to trade them just in vacuum. It has to be at the important support and resistance area. And then we make sure that it's testing the same support and resistance area in 2 time frame. And then we wait for a bullish or bearish candle close before entering the trade. So let's take a look at an example for that. So here again, we look at this CAD-yen pair. So we had prices was just consolidating, moving sideways, and then we start price moving to the downside. So the 50 moving average here is, my red line is 50, and then my blue line is 20, and this orange line is 8, and this green line is 200 moving average. So with the 200 moving average, we are just using it as a reference. There won't be, in most cases, it will take a long time for the price to come to the 200 moving average, which is fine. Which just means that the overall trend is then reversing, or at least is testing the 200. So we just keep it for reference. If the price comes to, let's say, 200 and rejects, then that's a very good signal that it's going to come down. It just gives us that signal. But here, because we are not going to wait for the price to come to 200, we are really working off of this 50, 20, and the 8. So the way to identify this is, once they come together, that means it's a range-bound market. So once they start fanning out, so once they start getting stacked, so here we have their up and down. So once they get stacked, for example, here we see the moving average 20 is crossing the 50. That means the trend is actually changing now. So the first one to move will be the 8 one. So that will be the quickest one. Price will keep coming and testing this level and then coming down. And the second one will be the 20, and then we'll have the 50. So once the price crosses 8, crosses the 20 to the downside, now we are starting to see momentum in price. And once the 20 crosses the 50 to the downside, so that they are stacked, that means we have extra confirmation. So to take an entry here, the easiest way to do this is to look for our 8 moving average here. So I'm on a 1 hour chart. This is a 1 hour chart. So we look for a nice, so in this case, the price is the moving averages are crossing to the downside. That means the trend is to the downside. So first we identify the trend, the market direction, which is in this case, because the moving averages are crossing to the downside. Here it's in a range-bound market. They're going up and down. Once they cross, see how they haven't crossed the 50 here? It hasn't crossed the 50 here. So here it's still staying above that. But once the 20 crosses the 50, then we know the trend is reversing now. And the 8 will be the first one to cross, but we wait for the 20 to cross the 50 to the downside. And now they're all to the downside. They're stacked to the downside, 8, 20, and 50. So once this cross happens, we look for a nice bearish engulfing candle. Because we're looking for a downtrend, we're looking for a bearish engulfing candle. In this case, we get a nice candle here, nice big candle, and then we can enter our trade at the close of this bearish engulfing candle. And a lot of times, this will be on your 8 moving average. So this is your 8 moving average. It will reject off of the 8 moving average. However, sometimes it may reject off of this one here, or 20 or 50, which is fine. So once the candle closes to the downside, our moving averages are stacked. We can take a short here, and in this case, we would put our stop above this 50 moving average here. So you want to make sure you give some room for this trade to play out, because it could go to the 50 and still could go back to the 50 and reject from there. So we want to make sure there is some room for the trade to move. So we'll place our stop above the 50 moving average. Here we are on the 8 here. We're looking for bearish engulfing candle. We take our entry here. So, and then we are looking for price to basically move down here, and we can wait for the price to actually go back up and cross the 50 back here. So in this case, it gave us 86.30 to 83. So this is about 83.30. So exactly 300 pips in profit here. So following this system. So here, this is a more of a medium term kind of a trading strategy. So you put your trade in and you let the price run, and again, you're just watching it. You can look at it every hour, every 4 hours, or every day even. Just make sure when the price crosses the 50, you get out of the trade, because then as you can see, the price is starting to move to the upside, and this is current price action, so we don't know what will happen here. However, once the price crosses here, you can just get out of the trade, and this is essentially your trade setup. So you're starting off with the criteria you're looking for is, one, they have to be stacked, so that if you're looking for a bearish trend is when the prices are moving to the downside. Here, as you can see, there's 8, there's 20, and 50 moving averages. So you're looking for a bearish candle close, a strong engulfing. This is an engulfing candle. It takes out the previous couple of candles here. So this is a very strong engulfing candle, bearish engulfing candle, and you take your entry here, or you can wait for a pullback. In this case, there wasn't much of a pullback, so you can just take your entry at the close of the candle, put your stop loss above the 50, and you're waiting for price to basically, in this case, it came very close to the 50, but it didn't actually cross over. So waiting for the price to cross back over the 50, and this is how you're taking your trade. So you wait for the price to cross to the downside on the 50, and then you're waiting for price to close above the 50 moving average, and that's how you're entering your trade. So for a shorter term, if you didn't want to hold your trade for a long period of time, what you can do is just first look for moving averages to be stacked. So that's the first criteria. And then we don't need to really wait for price to go back above the 50. You can just work with 20 and 8 moving averages. So once the price closes below the 8 moving average, you can still put your stop loss above the 50 if they are close, or you can put it above the 20. Just give it some room. So like right here, so just give it some room to work with. You don't want to suffocate your trade, so just put it above the 20, and then you can enter your trade. So as long as the price stays below the 8, you're in the trade, and once the price closes above the 8, you are out of your trade. Then you would just close out your trade. In this case, what would happen is you will get more entry signals and more exit signals. So this will be an intraday trading strategy. So you only want to be in a trade same day. So you want to get in and out of the trade the same day. So in this case, if all the moving averages are pointing to the downside, which means the trend is to the downside, you would wait for engulfing candle to price to close below the 8 moving average. You would put your stop loss above your 20 moving average, and you would look for price to go down. So as long as the price stays below the 8, your trade is good. As soon as the price closes above 8, you are out of your trade. So in this case, you would enter over here and you would get out over here. So this wasn't a big move day, but you still made I think about 50 pips or so. So 86 to this is what 80. Well, you actually made good amount of money. So 85.72, 85, 85.12. So that's not bad. So around 50, 60 pips there. So that's not bad profit for intraday trading. Actually, that's really good profit. So that's another strategy you can use. So basically, you're looking for a close below the 8 moving average, and then you are putting your stop above. So in this case, it could have hit your stop loss here, right? And that will happen about 30% of the time. That's just the way trading is. You'll have wins and losses. In this case, this was I'm not sure, I think it may have been some sort of news event. So you do have to pay attention to those. And you just basically, when you're entering, so you're looking, also, if you look for a reversal pattern, so this one here is a nice reversal pattern. Actually, this is it's an engulfing candle railroad track. And if you look for, in this case here, I do not show my support and resistance, but if you draw your support and resistance areas, for example, right here is a support resistance area. So this trade here is a good trade because it matches your support and resistance area, and you have your moving averages. So you have confluence, two different things coming together to make your trade a good trade. So keep that in mind. Make sure you are taking trades at important support and resistance area. It will just increase the probability of the trade working out in your favor. So that's one example. So let's go back to our slides here. So again, like I said, make sure the moving averages are stacked. You draw your support and resistance line. You're waiting for a bearish or bullish candle close before entering the trade, which is what we covered in the example there. So how do you take your profit? There are a few different ways of trade management that you can apply here. One I just discussed, you can wait for price to close above or below the 8 moving average, or for a longer term trade with 50 moving average. Another way, let's say you didn't want to wait. So if you take a look at this example here, see when the price closed above the 50 here, you gave back all this profit. So you could have had another couple hundred pips in profit, actually 150 pips in profit here. If you had not waited for the price to close above the 50 moving average. So another way of managing trades here is you can also do, if you didn't want to use moving average to manage and exit the trade, what you could do is you can use candlestick patterns. So if you have, sorry, 1 second. If you see a candlestick pattern like this one, for example, this is a stop run, there's a big rejection to the downside, and then the price starts moving up, you get engulfing candle here, you can close a trade based on candlestick patterns. If you didn't want to do that, you can use something really simple like this. So for example, we entered our trade in this case here. We entered our trade here at the close of this candle. This was our entry. This was our stop loss. So what you can do is you can have your take profit, the first take profit, so you can scale out of your trade. So you can have the first take profit at about the same level as your risk was. This is your risk up to your stop loss, and this is your take profit. So you can have 1-to-1 risk to reward ratio. So you can take 1/3 of your closeout, 1/3 of your trade, so that at least you've locked in your profit, and then you can move your stop loss to break even +2, so that at this point you have taken some profit off the table. You have no risk in this trade. Even if it were to come to stop you out, you make +2 pips plus whatever you took off the table. So you let 2 portions of your trade run. So the second one you can take out at 2-to-1 risk to reward ratio. So this is the second portion. Basically, you took off the first part of your trade at 1-to-1, you take out the second part of your trade at 2-to-1, and then what you can do is you can just let the rest run. So when the price comes down here, it will take you out. You keep moving your stop loss as the trade works out. So once the trade gets here, for example, move it up here, just move it above the next swing level, and then you're waiting for, so either the price will come back here to take you out of your position, the last little bit of your position, or once you see a close above the 50, you can get out of your position there. So that's another way to manage your trade if you just didn't want to just let all of it run, because sometimes what can happen is it will do this, come down here, and then come back over here, right? So you are pretty much, although you had all this money in the trade, you got out with pretty much nothing. So the way to get around that is to take one part of your trade at 1-to-1, second part of your trade at 2-to-1, and then let it run. In this case, the yen pairs are nice ones to trade like this. And what I would suggest doing is when you do your weekly analysis, just take a look at your charts and to see which ones where the moving averages have started to fan out. Where are they stacked? So that the 8, 20, and 50 are, they're in ascending order. So where are they getting stacked? And then you can look for those. You can look to trade those pairs that week. In that case, you'll be able to find some of these moves. So have 5 or different pairs, whichever you're interested in. Yen pairs, like I said, are good ones to trade. So just look at those, do a weekly review of the different pairs, see where your moving averages are crossing like this. They are changing the momentum here. See how everything was above the 50 and now it has crossed to the downside. So you're looking for this cross and you're looking for trades, these to start moving away from each other. And once that happens, you can trade those. Now let's take a look at another example. So this is Euro Pound. This was a nice trend we saw this week. Pound was dropping and Euro, on the other hand, was holding steady. It was in that big range. So Euro Pound was a good trade to take this way as well. So here we see that the moving averages crossed over. So the 20 crossed over the 50, 8 had already crossed. So you want to wait to get your 20 crossed over the 50s just so that you have some market direction. So once they start fanning out like this, in this case, it's the uptrend. See how they're moving up? So we're looking for uptrend. So once they start separating from each other, you have your trend in place. So once you have trend in place, we are looking for a place to get into the trade. So one way to do this would be you look for this type of a setup. So you have engulfing candle here. So you see price came and tested the 20 and then closed above. So this engulfing candle took out everything over to the left here. So this is a nice, so this is a good way to see that the price has rejected the bottom and it wants to move up. So this shows that there's momentum to the upside because the price is not willing to go low, it just wants to close up high. So in this case, so we look for some sort of a pattern like this, and in most cases this will set up at important support and resistance areas. So make sure you identify your support and resistance areas, and then once that happens, you can take an entry here, put your stop loss either below this swing, or you can put it below the 50 line, but make sure you give it some room because it could come down and test the bottom once again, and you don't want to be taken out of your trade just because it's testing. So give it some room, and then your first take profit can be 1-to-1, which will be here, or you can just wait for price to cross the 50, which it does over here. So once the price crosses the 50, you would get out of your trade. And in this case, you have made, we started at, let's take a look here, 79.10, and we are out at 79.65-ish. So you've made about 50 pips or so here. So not a huge trade, but still you've made money in the trade. But if you did the one to, you could have the other way to manage this one would be you do one to take out one portion here, take out the second portion here, and then you take out the third here. So again, it's up to you. And there's one more thing you can do. So if you did not want to, like I said, if you did not want to wait for 50 to cross over, you can just look for, once the price crosses to the downside on the 8, you would get out. So you would get out of this trade here or somewhere in here, and then this gives you a signal for entry again. So once this engulfing candle closes, you are in again. So this is your intraday. So for the intraday, actually you don't make a whole lot of profit here because you probably get taken out at your break even right here, and then unless you took 1-to-1, and then you would re-enter because immediately you get a re-entry signal, and here you get re-entry signal again. So the downside of only of trading with your 8 moving average is that you get a lot more in and out. You get a lot more signals, but for intraday trading, so if you're in and out of the trade the same day, it's actually a good thing. However, if you do not have that much time to trade and you wanted to trade over the long term, you can just wait for your price to cross over to, under the 50. So that happens here, it happens here, and of course then see how it starts going sideways now. The moving averages are coming back together again. So now there is no trend in place. So this is the type of market we do not want to trade because price is not going anywhere. At this point, price needs to make a decision where it's going to go, whether to the upside or downside. If the moving averages start crossing to the downside and start fanning out, then we can look for a trade somewhere in here. But here there's no trade at this point. So this was a good area to take a trade, because see how the price is starting to separate here, and now price has started coming together, and there would be no trade at this point unless the prices the price either crossed to the upside and stayed up, or crossed to the downside under the 50 and stayed to the downside. Let's take a look at another example here. Again, this is a yen example because, like I mentioned, this week, and this is just this week. So this is April 7th, April 8th, April 5th, 4th. I was trading this one, so I thought I'll use the yen pairs as example. So here again, we see the 200 moving average, which is the overall longer term trend. It's all to the downside here. And you see your 50 moving average is moving to the downside. And here, see how they're all together? They're all together. So there's no trade till they start to fan out. So here they have started fanning out. Here they have fanned out. So we could take a trade somewhere in here. So in this case, again, we are looking for a trade either at the close of this or at the close of this red engulfing candle. So we always want to make sure there is one important support and resistance level. So if you have your zeros or any important support and resistance level, first look for that. And then as the moving averages start to fan out, so you have 8, 20, 50, and then, of course, your 200, you can be, it doesn't always have to be stacked properly, but these 3 have to be stacked. So once they are stacked, they're starting to open out. So probably over here in the real time, that's when they really will be open. So you can take your enter here, and your stop loss could be either above this candle right here, or you can put it all the way up to the swing high. Either one is fine. And then you are looking for basically a cross back above the 50. And in this case, actually, it hasn't really crossed back above the 50 yet. It did go and test the 50, but it's still pointing to the downside. So this is how you can trade the longer time frame charts where you're sitting in the trade for a few weeks, a few days. So you don't have to look at your charts every second of every day. So it just frees up your time. You can look at the charts every once in a while, and you can set your alert. So once the price crosses a certain significant level, you can have your alerts in place so that you're aware of that to enter and exit trades. But again, you're waiting for the longer term trading here. You're waiting for the price to cross over in the opposite direction of your 50 moving average. Okay, so that's all I have, I think, here. Yeah. So any questions about this? Did all of this make sense, or do we want to look at a few more examples? You can put something in the chat. Okay, so someone said very clear, and someone's asked for more examples. So another question here is preference of simple moving average as opposed to exponential moving average. They are usually fairly similar. I would say try out both of them, put them on the chart, and then let them run over over a period of time. What I found is that they both work. Most of the bigger, the professional traders and institutions, they use the simple moving averages, but they also trade the longer time frame charts. So they're trading the daily and the weekly charts and so forth. For the exponential moving average, they tend to set up quicker. So they will take you in and out of your trades faster than the simple moving averages would. So that's really the only difference between the two. The exponential moving averages focus more on the latest price action. So they're not concerned about what happened back here. They're more concerned about what's happening currently, for example, or so they place more weight on the latest price movement. Some people prefer EMAs, some people prefer SMAs. So either one is fine. You can try that. Sorry, I have my baby here with me today, so bear with me, please. Okay, so let's take a look at a few more examples. Oh, sorry, another question that came out was what pairs are good to trade with this method. You can trade any pair that has a lot of movement. So some of the good ones are yen pairs are usually good. So pound CAD pairs like that are good to trade. Anything that has movement. So what I like to do is put a few different charts on. Like for example, pound US dollar this week was a good one to trade because there was enough price movement. However, euro US dollar this week was awful to trade with the moving averages, or there was no momentum. There was really no move. It was very range bound kind of move in that. So yen pairs are usually good for this. Pound pairs, anything that has pound in it is usually good, especially now with all the concerns around Brexit. So there's more pressure on the pound. Euro currently is not doing anything, so that one's not very good. But euro yen actually is good. I was trading that this week, so that one's good to trade. In terms of how long do I stay in a trade, it could be a few days. I like to scale in and out of my trade. So what I do is, like I said, I take out parts of my trade. So when I get my 2 to 3 take profit, risk to reward ratio, I take my profit out and then I would re-enter because I know at some point there will be a pullback and the price will come back towards the moving averages. So the moving averages at some point would be crossing. So what I do is I take out, because if you were in long in this trade, there's no point in really giving back all this profit. So what you could do is you could take out your profit once it starts going sideways. So if you know price action, you can just wait. Once this starts going sideways, you can take part of your position out so that you can re-enter here. So I leave 1/3 running, and then I would go back into the trade so that then you catch the next part of the move. So I don't like to leave all of it running for the longest time. I do take some of it out because you never know when it could go in the opposite direction. And another question was, how does this compare to robo strategy? I actually don't really know the robo strategy. I don't trade it, so I may not be the best person to answer that question. So let's see if we can take a look at a couple of oh, that's an ugly chart. Let's see if we can take a look at a couple of other pairs here. So we looked at pound CAD we haven't looked at. So this is the pound CAD chart. So here, this is the pound CAD 1 hour chart. So as we can see here, moving averages they bunched up, came together, and this is where they started fanning out again. So here 200, a lot of times you will see setups on 200 moving average as well. So pound pairs usually take off quite a bit, but for pound CAD, here we see a nice move to the downside. We got rejection off of the 200 moving average, and then things started stacking up. So here, as you can see, we have the 50, 20, and the 8. They are actually stacked now, so they are in order. So that's what we're looking for. So we once that happens, we can take a trade on the pullback. So this is our support and resistance, market support and resistance. So this is the immediate support and resistance. And then you can look at, you can look at your support and resistance off of the higher time frame as well. So here we look, oh, sorry, I lost it here. Okay, sorry, here we were. So once this candle closes, you can either look for a pullback or you can take a trade off of it right here. Then make sure you put your stop loss above this 50 here or above the swing point, because sometimes it can go do a double top here and then come down. So put your, in this case, let's draw some support and let's draw entry. So you can either enter right at the close of this. I like to get a pullback usually. So you can enter here on pullback or you can enter right here, and your stop should be above this candle. So it should be above here somewhere, and you're looking for first target will be 1-to-1, or you can just wait for it to cross back up here. So you get this, you get out over here essentially. So that's just another quick example of this strategy. For Fibonacci, for range bound, I consider Fibonacci actually with this. I use Fibonacci just to look at my targets, profit targets, and for pullbacks. For range bound trading, not so much, because range bound is really, you just draw your support and resistance. So this is actually a little bit here, range bound right here. So this is the top side of your range. I could have moved it slightly higher, and this is the bottom. So all this price action in here is all range bound. So for the range bound, I am just looking to sell at the top. Like here, for the range bound, I would have sold here and really gotten out somewhere in here, even at the bottom of the range, because this bottom has already been established and the top here of the range has been established. So once it closes inside here, you can put your stop above. Let me just move this out of the way. So you can put your stop above here and sell right here. And basically you try to get out somewhere in here before it hits the bottom of the range. So I don't use Fibonacci for the range bound, but I use it to draw out profit targets for momentum, or sorry, trending market. All right, so, oops, sorry, I accidentally unshared my screen. All right, so any other questions? So that's all the questions. So let's move to the next slide here. So that is all I have for our training, unless there are any other questions. So if you would like to learn more trading strategies like this, I invite you to check out my course. It's at tradingwithvenus.com/Forex course. it is it's the price for that is $297, and in that I share with you everything from introduction to trading, and then I go into some of the strategies that I use all the time, and some things that I have found really profitable. So Fibonacci trading, I love trading pivot points. So that's one of the things that, especially for intraday trading, if you're doing short-term trading, pivot points work out really, really beautifully. So I explain that. And I share a few more strategies that I use every day in my trading. So that would be a course that I would suggest checking out. Reversal patterns. I love reversal patterns. I'm a price action person. Moving averages and things like that are just a tool that you can have in your back pocket. I'm a price action person. So I absolutely look at reversal patterns, and they form a big part of my trading. And that's one of the things I cover in my Forex course quite extensively, are the reversal patterns. All right, so we will, one more question. Do you enter multiple lots for scale out? Yes, or I have a position size that I like to enter in with, which is my normal position, and then I take out part of that position. So let's say if I'm trading one standard lot, then I will take out like 3 minis out at the first 1-to-1 risk to reward ratio, and then 2-to-1 I'll take another 3 out, and then I will let the 4 run to the end, and then I go back into the trade in again on the pullback. So I have basically 1 to 2 kind of standard lots running, and then I go in and out of those. All right, so that's all I have for today. In terms of how much attention does it take? So if you're trading it over the long term, you just want to look at it at least once a day. I would recommend looking at it a couple times a day so that you know where your trade is at any given moment in time. For example, the yen pairs, they could run for 2, 3, 4 days, even weeks on end. Right now, they just have been in such a big downtrend. They're breaking through all kinds of levels. So it doesn't need a lot of maintenance. This is a longer term trading strategy, something that you can do quite easily without focusing too much on it. Okay, great. You guys have a great rest of the day. So I will see you on the next webinar. If you have any questions for me, feel free to send them my way. My email is raman@tradingwithvenus.com. Okay, thanks, you guys.